All right. Well, welcome to this week's stock market review. My name is Bennett McDowell with traderscoach.com. And once again, good to be here. All right. So market's coming down a little bit today. We're going to take a look at the charts and see what's cooking on that. We're going to cover housing. We're going to take a look at some of the cryptos, Bitcoin, for example, and probably some of the ETFs associated with that. So let's go ahead and jump right in and get going here. First thing, of course, I want to cover are the risks involved in trading. But before I do that, let me just take a moment here for just a moment. Give us a like if you could right now. That helps us on the ratings in YouTube. Share it with your friends. Do all that good social stuff and keeps the channel alive, so to speak. All right. So on the risks involved in trading, please make sure you fund your account with money you can afford to risk, called risk capital. That's really important. Also, too, check with your financial advisor to make sure anything we discuss here is suitable for you. We don't know your personal situation here, and of course, they certainly should, or at least do. Also, too, make sure you actually know your risk before taking any individual trade or investment. Always look at your downside. Try to control that as much as possible. In active trading and investing, I have a whole series of money management books that can help you with that if you kind of don't know how to do that, but it's really important. That's a good aspect of it. And then finally, realize no guarantees in trading the markets. That's exactly why you need to use risk capital and be very careful with risk control. All right, a couple of books I was mentioning before are our money management books. They're in front of you now. I'll put some links in the recording down below there that you can check out, or you can go to our website for that. Also, too, my new book, The Art of Trading, second edition, coming out later this summer. Going to be, I think, the best book I've ever written. We're going to have a lot of good new material in that, and you can pre-order that. And again, I'll just put the link down below. All right. In terms of the economic situation, the calendar, let me go ahead and just enlarge that. We're kicking off here Wednesday, the 24th. Okay, no FOMC this week. Okay, so you can breathe easy about that. We are going to talk about interest rates, but for today, we've got durable good orders coming out. Crude oil inventories, those are the major ones for today. And for tomorrow, the major ones are GDP, initial jobless claims, and then Friday we have core PCE. All right, so nothing major there that's going to disrupt the markets this week that I can tell. All right, I'm going to go ahead and go full screen here and enlarge this as well once again. All right, so last week, Powell basically announced that the Fed is dialing back expectations on rate cuts. Okay, so what does that mean exactly? Well, 6 months ago, going into the new year here, they were talking about possibly six rate cuts. Now we're down to around 2, and some people will be lucky if we get that. And it's because of inflation, and inflation has not calmed down yet, and that is still a problem. So being an election year, probably I think we're going to get one at least before the election. I think they're going to try to do that to basically spur the economy on, or at least keep it stable. Real estate is interesting because real estate, the prices have remained high, but there's not a lot of sales out there. The inventory's grown a little bit this year, but sales still remain pretty lackluster. And that's simply because on the housing market, has not taken off because mortgage rates now are over 7%. So the average rate on the standard 30-year fixed mortgage jumped by nearly a quarter percentage point to 7.1%. All right. And so that's pretty tough. Okay. It's getting up there again. And that's the highest level since late 2023 and the largest weekly increase in nearly a year. And that's because of this change in stance that the Fed is taking on lowering rates. Basically, mortgage companies are trying to adjust for this change and protect their downside. So they're going to keep rates up until we see a clear direction. So that type of thing is a problem. So and that's causing, basically house sales to be kind of lackluster, even though there's more inventory. All right, so when we look at charts, and I'm going to show you a couple charts, I'm going to dive into various markets here. We're going to be using software. I'll put a link below if you're interested in getting our software, but it's also available on the website. We have charting software, scanners, and risk control. All right, so here's the Dow Jones Industrial Average. And basically, I've magnified this to basically start in October when we had this big run up here. And this was in terms of an Elliott Wave. For you Elliott Wave guys, if you're like me out there, that's an Elliott Wave 4. And notice there are 5 waves, for those unfamiliar with Elliott Wave, in a trend. And then the trend ends on the 5th wave. So we're in that 5th wave. We got very close to the target for the 5th wave up here. So the target technically was 40,281 up to 47,426. And we got fairly close to that. Didn't hit it, but fairly close. And that's a fib extension based off using points on the Elliott Wave to draw that. So that's pretty accurate. Now, one thing statistically, all right, we sometimes miss the target, and that happens about 15% of the time. So it is possible that the top is in the market and we could just keep going down from here. That's possible. Not likely, because 70% of the time they hit in between the actual target zone right there. So that is probably more probable. Statistically, you know, we're close, okay? So you got to keep that in mind. So any pullback right now I'm looking at is basically only that. I call it a profit-taking pullback. And that's because we have not hit the statistically high target zone of 70% of the time. So that's kind of where I think we're in. We're anticipating this. I'm going to show you where I think the target's going to end on this in a minute. But I just kind of want you to see the overall visual on this, that basically this should come down something like this and then head back up into the target. Now, if this forecast becomes reality, then I think we're probably going to get into this target area probably later in this year, maybe early 2025. We could be in there by the election time. We'll have to see. Maybe after the election, we jump in there. But I think the party should end by the end of the year. Now, what does that mean? Well, that means that once we get into that wave 5 target zone, if we see selling coming in at any time and it starts pushing the market down dramatically, and we start taking out certain price levels that I will project when we get to that time period, then we're on our way down to a major bear market. And then we're looking at a stock market correction, probably 40, 50%, in some cases, maybe more. I'll have to see once we hit that target. So, you know, if I go out 6 months to a year from now, I'm very bearish on the market. All right, short term, until we hit that target zone and until the market proves me different, then I'm basically overall bullish on the market. However, we're in a short-term pullback right now. And if you have any questions on that, feel free to ask. One more thing I just want to share is that if this is a top here, and this is one of the 15% times that it does not reach the target zone, then the next major point we're going to look at here is this low here. So if the market craters down and goes below that point there, which is the October low, then that means the top is in definitively. Okay, so anything pulling back before we go below that October low is merely profit taking in wave 5 that we're currently still in. So I just want to make that clear. Now, there'll be some different setups, of course. We'll have type of, the market doesn't do anything in a straight line. It kind of is ziggy and zaggy. So if we do some zigzags here and we start, we don't see a rebound, but we see a downtrend forming, we're going to take note of that as well. Okay, but you do see that also in profit taking. Okay, so just keep that in mind. So my forecast for this is that we're in a profit taking pullback at this time, and we should see a rebound from this. And if we don't, then we're going to have to look at price levels being penetrated to see what's going on. Now, here's my target zone for the Dow Jones. So basically, we hit it here last week. Now, this is a 60-minute chart, so this is a fairly short-term chart. But I use this because it's a nice chart to clearly draw the anchoring points for a profit-taking pullback zone. So we got into this profit-taking pullback zone already. So I'm kind of liking that. However, all right, I also try to look for an Elliott Wave pattern of a zigzag. We've got a couple of them here. We've got possibly A, B, C. So this could be over. Profit taking could be over. But this also could be a long-based A, and they do sometimes hit the target, followed by a B, and then followed by a C, and end here in what we call a 4, and then go. So we're kind of waiting to see how this move up progresses. I'm waiting for a significant pullback. We may be getting it a little bit today. So we'll take a look at that on the live charts and see if that's giving us any more clues. But I just wanted to make sure you realize we did hit that target zone that we anticipated, but we may hit it again. So we're going to keep an eye on that for you. That's why you want to come back every week so we can kind of update stuff. All right, on the S&P, this is another reason why I don't think we're quite at a top, and we're going to look at the NASDAQ too, is take a look at the S&P. We did not come that close at all to the target. Now, in terms of a wave 5, this is a 3, 4, 5. One of the characteristics of a 5, of course, is to get on top or breach in a bullish market. Wave 5 breaches the top of wave 3. So that did happen. So again, we're in that 15% statistical period where we may have a top. But this one's a little further away. And what I'm liking to seeing over here, look at this. Okay, we're seeing a green PTF right now. And so that's indicating this move is not done and wave 5 is not done. And we also see that as well in the Dow. So I'm thinking we got more upside here on the S&P, the Dow. And if we take a look at the NASDAQ, the same thing. Now, before I go to the NASDAQ, a couple things, okay? Here's our profit-taking pullback on this left-hand side chart here. So this is our 60-minute chart, kind of like what I showed you with the Dow. All right, and the zone for this to get down to is 49.12 to 46.94. So technically, we're not down there yet. Again, this zone also has a percentage here. And again, we're in the 15% area, but the 70% area is there. So I don't think we're quite done with the move down. All right, we may be seeing a zig and a zag right now as we move down there. So this chart helps us kind of take a look at the S&P 500 and say, okay, we got a little bit more move to the downside, then profit taking should be over, and then we should move back to the upside. Very similar to what we're thinking is going to happen on the Dow. And then if we look at the NASDAQ, it's the same story. All right, so the NASDAQ a little bit different. Okay, here's our target zone down here to 14,993 to 14,038. And then after we hit that, we should go back up. And you can see we did not come close to it at all, the right-hand side chart. So the target for the NASDAQ still remains at 19,164 to 24,880, okay? And if we go back 1 second quickly to the S&P, the target for the end of wave 5 is that center chart here. And that's indicating right here. And that's indicating 5,652, all right, up to almost to 6,988. All right, so possibly still quite a ways to go. And again, if you think about it and try to fit it in with what type of year we're having here, you know, we've got a lot of disturbing news out there, higher rates, you know, the conflict in the Middle East and so forth. And yet the market has not crashed. All right. So that's kind of an indication that we are in a bullish impulsive wave. And in Elliott Wave terms, whenever you're moving in the direction of the wave count, so to speak, the trend wave count, then the market ignores bad news and focuses on the good news. In a bear market, then the opposite happens. All right, the good news is ignored because the mood's changed, and the bad news is accentuated. So I think probably a little profit taking here. We've had a nice run since October, and then we're going to have to see in this election year, they may drop rates that may spur enthusiasm and so forth. So that's the kind of overall market situation. Now, I want to jump to real estate quickly here. I know I show this chart every week, but I want to keep track of this. So this is the Case-Shiller Index versus the CPI, which measures basically inflation. So you've got the Case-Shiller in red, and you've got the CPI down here in black. All right. And so this chart was just updated this week. And the thing you want to take away from this is notice how, well, the Case-Shiller index, first of all, represents the average prices in the United States on residential real estate. Now, real estate is very local. All right. So you may be seeing something different locally than is represented as a national average. But this is kind of what we talk about when we look at real estate in general, okay, across the U.S. And this is a great chart or graph because it really illustrates a couple things. One is that if you go back to the beginning of the chart, which is the 1970s, all right, real estate always has been a hedge against inflation, which is measured by the CPI. And so the Case-Shiller line indicates that by being above the CPI. So real estate's always been one of those things that's a good investment for pretty much everybody when they can afford it. And you'll basically have a place to live, but also you'll be keeping up with inflation. So it's a kind of a, kill two birds with one stone, so to speak, right? So it's always been a good thing to do. All right. Now there's times like in the stock market where you have things that get crazy and out of control, and those are bubbles in markets. And real estate is no different. And this goes back to the financial crisis. I'll just put FC. And the financial crisis was interesting because it spanned over, a few years, about a year and a half before the market actually imploded. And to make a long story short, basically a couple things happened that caused that. One is the mortgage industry changed its rules to where they could start putting mortgages in mortgage-backed securities and securitizing those. And so basically the game changed for lenders to be more proactive in getting as many mortgages as they could so they could make money on the secondary market and package these to investors in the form of mortgage-backed securities and REITs and things like that. And so the lending standards kind of went down. And what they focused on during that period is not so much a mortgage applicant income, but more just on general credit ratings and house values. So it was very easy to get a mortgage with, and so there everybody said, okay, let's jump in. The interest rates were fairly good then too. Let's jump in and get real estate because now it has so many advantages. It's easy to get. All right, I can do it on borrowed money. There's usually no income check. And so housing took off. And we got the Case-Shiller fairly far away from the CPI. And when you see that, that's a bubble. All right. So then, of course, everybody knows what happened on the financial crisis. It busted. All right. People, the economy went into a recession. They couldn't afford mortgages that they shouldn't have gotten in the first place. And the rest is history. So then the market comes down and then it reaches a value point here. The Fed stimulates the economy improves, and we're off to the races again. And this is how the market should work. All right. The markets basically should correct themselves when they get out of bounds, so to speak. May not be instantaneously, but it should at least happen. So then we went into this period where, again, real estate was a really good investment. People got down to affordability levels again, and people bought it. And then you had COVID, right? So then COVID came around here, all right, and they loosened up the money again, lowered the rates, and started giving out stimulus checks. And people were moving out of the cities for the pandemic, and things continued to just accelerate. And here we are today. And the point I want to draw with this chart is look how far the Case-Shiller is away from the CPI. The CPI, you can see, bumped up here during this period we're in where we have inflation. Okay, but so is housing. So we're pretty far. We're double the distance as we were back in the financial crisis. That should concern everybody. Okay, so that's not a good sign. But prices have remained high, and of course, a variety of different circumstances this time as compared to the 2008 crisis. It's always different, but it's always ends in the same, which is a correction. So we've got a situation here where prices have remained high, and yet actual transactions have remained low. And the reason for that is the raise in interest rates. And a lot of people are sitting in homes with low interest rates that they don't want to trade into higher interest rates. And I get that, right? All right. So there we are. So prices just kind of remain up. Now, the main culprit in this is low inventory, of course, but also too, which is keeping the prices up. There's low demand, so it's kind of stagnant, and it even is stagnant right now. But like in the financial crisis, you can have this for quite some time, years, before you get a bust in it. So take that away as not a matter of if, but more a matter of when this market should correct down to the CPI. And this big move up also has been helped by the Fed, stimulating the economy. All right, and causing higher inflation by doing that. All right, this is kind of a neat little graph from RE Venture Consulting. It is coming up on almost a year old, though, so I'm certainly hoping they'll update this summer. But in any case, once again, it shows that home prices versus incomes are way out of whack. And here is the financial crisis. I'll put FC here, and here's where we are now. And this has even turned back up. So, in terms of homes versus people's income as an average, is just, unaffordable right now. And with the higher rates, it makes it even worse. But also, too, when you start taking into account another factor, which is folks' debt. Okay, everybody, the debt to income ratio for home buyers is just insane right now because of the high credit card debt and car loans and things like that. So this graph shows, once again, another look at the bubble that we're in from a debt to income ratio. So that's kind of, we're kind of getting overextended here as well. So that is interesting. And you can certainly see on this next graph here, this is total credit card debt in the US, and this is pretty recent, 1.13 trillion, okay, up there right now at the end of Q4, and it hasn't pulled back. And you can see how the increase on this is just taking off. All right, there's a lot of speculation why. Of course, things are more expensive, inflation, right? So people putting it on their cards and not being able to fully pay it off. But you also had, back in the 2020 period, in this period here, you had the pandemic, all right, COVID, and it came down, all right, because you had a lot of stimulus money. And then the stimulus money went away, all right, they're not doing that anymore. And people, were used to their lifestyle during that. And they have continued that lifestyle by financing it on their credit cards. So the bottom line is the total credit card debt is way out of whack and increasing dramatically. So if we go back to this graph I just showed you here and enlarge this, it's even worse now. And at this particular point, the debt to income ratio is about 40%. It's probably like 50 now, or 45, right around there. And that was bad. Okay. So again, this is not boding well for not only the economy, but for real estate in general. All right. And then new listings on the US housing market. This is fairly recent, but not current. But it was ticking up, and I've heard it's been continuing to tick up. So the inventory is starting to come on. People that have waited long enough, and they're kind of getting a little bit more used to the rates and from a home seller's situation. But by no means is the inventory anything like it used to be back in the go-go years, right? So again, the problem is the demand's not just right. It's just not coming forward because of the higher interest rates. All right, so I kind of wanted to share those charts with you. I think they're important. I'm going to jump on now here and just take a look at the current market. So on the Dow here, we can see that we're jumping up a little bit here. However, today's kind of a little bit of a bearish day. So it'll be interesting to see if now we get one more thrust down to indicate a downtrend. So again, I don't think we're quite out of the woods yet on this correction. Now, if we get something like this, and I'm going to enlarge this again, and this is again why, we look at this so often and update things every week, is that if we get this and then get this, well, then we're in an uptrend, right? If we get this and get this, then it's a continuation of the pullback that we're in. So that's why you got to keep looking at this. But again, look at this. All right, this is bullish across the board right here. So because that's bullish, that's another indication, like I showed you on the S&P and the NASDAQ, that we have not reached the target zone, the upper target zone. And that is why I say with some form of confidence, because this indicator has a 75% accuracy rate here, I say with confidence that we're going to make more highs. And when it's green, you take the highest high in the green area. And there's a 75% probability we'll take that out after the pullback. Okay. So I'm pretty confident, not 100%, because nothing could be 100% in the markets, but pretty confident that this bull run in the Dow is not over yet, but soon will be. All right. So I just wanted to share that with you. I'm going to move on to some kind of important markets here. I know everybody likes to talk about crypto, and I think crypto is going to be even more talked about. But this too has been in a pullback, and I'm kind of seeing if we're out of the woods yet. It has not gone into the target zone by any means. Now, it hit the 15% mark, just like those other ones, but this is the 70%. So, we still could see a dramatic pullback. We've got over here the PTF just about turning red. So the long-term charts are indicating crypto's in a bull market. We just got to suffer through this pullback. So depending on how you work with crypto, are you an active trader? Are you a buy and holder? You're going to approach how you're going to handle this pullback in different ways. And for those of you that are a trader, you might be getting out and trying to get back in down here. That's what we do, right? If you are a more long-term holder based on the fact that the weekly chart is still bullish on the right-hand side, you're still using technical analysis, mind you. But in this case here, you would use this as an accumulation stage and then keep what you have. So you're going to have to decide how you want to play it. But we could see some more downside with crypto short term. And that's going to go the same. GBTC and all these other types of things will follow this trend as well. Okay. And again, we have the red owl, which is our optimum wave locator. You have to have this red during a 4, and then usually that means it'll pull back into this area. And we do have a red here. So I know if you look at YouTube, people are saying, this is going to 120,000. And I certainly think it probably will as well. All right. So I'm not giving up on Bitcoin, but I'm just saying you're going to have a pullback in it before you get to those higher levels. Okay. All right. So that's my summation on Bitcoin. All right. Gold. All right. Gold has taken off. We're seeing a little pullback on it now, but as you can see on both the middle chart and the chart on the far right, we have that PTF still green. So gold's not done. That's going up. Now, silver, very excited about silver because silver was remained undervalued for the most part compared to gold. So this was kind of a late bloomer, so to speak. And the price has remained fairly constant, right around 20 to 26 for quite some time. But it's breaking out now, and I'm seeing some very bullish long-term indications on silver. So I think this is an excellent buy. Again, talk to your financial advisor, and you can get this as an ETF SLV, which is what I'm showing you right here. And the previous one I showed you is GLD, which was gold. Now, a couple more things out here. I want to take a look at the bonds represented by an ETF TLT. Now, there's a lot of YouTubers out there that are recommending bonds. I'm not, okay. I don't think bonds is a place to be in right now, whether it's treasuries or anything else. And I've got a red PTF on the long-term charts on the right. We're seeing this market come up and come down. So this is showing, unless this is wrong, which is wrong 25% of the time, right? This bottom shouldn't hold. Okay, that should be taken out. So I don't think we might not have a bottom on TLT. Now, when a bottom occurs on TLT, hey, I'll be right there and buying it, okay? But I don't think we are at that at this time, okay? Now, UNG, which is natural gas, which is an interesting one, all right? Just made a new low here, a week or so ago. And yet, if you get your gas bill, you certainly don't see that reflected, do you? But in any case here, definitely going down. This is getting close to a bottom as well, all right? Could we be at a bottom? It's possible, but I need to see some follow through first. We still got an active bearish trend on basically the daily and the weekly charts. So from a technical standpoint, hasn't changed yet. All right, but we'll keep an eye on it because this will be a great trade at some point as well. All right, USO is the last one I'm going to look at today on the overall index markets, ETFs rather. So we're bullish on oil. It's been a little volatile. All right, our bullishness has nothing to do with in terms of our interpretation of what's going on in the Middle East. This is purely from a technical standpoint. And so we had a 3 here, 4 here, and we're reaching up to a 5. We should break $100, I think, sometime by late summer, early fall. All right, so that's kind of where I think that's going at some point. So, I think it's what, almost 80 now, 79.69. So kind of getting on up there. All right, so we've had this as a bullish recommendation on our Moore report for quite some time. All right, so now that's basically what I wanted to cover today. All right, so I think we're in a profit-taking pullback at this point, and nothing really to be concerned about unless things deepen, of course, and get worse. So you always got to keep that watchful eye as the market unfolds. All right, so now in terms of individual stocks and markets that you may be interested in, we don't have time on a session like this to do that. This is basically me sharing my forecast of what I think is going to happen in the markets. And we come here every week to get an update to see if anything's changed. But we do have on Fridays, we have our Stock Analysis Friday session where you can bring as many stocks as you want. We're together for quite some time, and we look at them together using technical analysis and my software that I created that does that. And we take a look at the Elliott Wave. We take a look at fibs on these things, and we look for good candidates. And we usually find quite a few, unless we're near a market top. Currently, the last couple of weeks ago, we didn't find that many because, of course, the market was selling off at near its top, going into a profit-taking correction. But that's the place to come for that, and I invite everybody to that. It's Fridays. We start at roughly 8 a.m. Pacific time, and it's on our YouTube channel. And I'll put there'll be a link on our website for that, but I'll put one in the recording. But you just go to, basically, you just type in traderscoach.com, and it will take you to our site on YouTube where you can register for free and then join us every Friday. And we have a lot of fun there. All right, so that's it for today. We'll see you back here next week, next Wednesday at the same time. Hope everybody's doing well out there. And don't forget to give us a like. That helps the video get out there and reach as many people as possible. And thanks so much for being here, okay? So we'll see you next week. Have a good one, okay? Bye-bye.